Millions of homeowners across the country are sitting on a financial advantage most of them never planned for, and it's quietly freezing the entire housing market. It's not a law, not a tax rule. It's a mortgage rate. Back when rates were near record lows, a huge number of homeowners either bought or refinanced into mortgages at 3%, sometimes even lower. Since then, rates have climbed dramatically. That gap between what they're paying now and what a new buyer would pay today is what's known as the mortgage rate lock-in effect. Here's the math that's keeping people in place. Selling a home means giving up that old low rate and financing a new home at today's much higher rate, even for the exact same loan amount. That can mean hundreds of dollars more every single month. For a lot of homeowners, moving isn't just inconvenient. It's a direct pay cut to their monthly budget. The effect on the housing market has been significant. Researchers at the Federal Reserve and housing economists have pointed to rate lock-in as one of the biggest reasons existing home inventory has stayed unusually low. Homeowners who would normally sell after a few years, for a new job, a bigger family, or downsizing, are simply staying put instead. And that creates a strange split in the market. People who already own homes with a low rate are financially comfortable, sometimes sitting on significant equity. But people trying to buy for the first time face both high prices and high rates at the same time, a much harder combination than either one alone. If you're a homeowner with a low rate, this isn't really a warning, it's a decision to make with clear eyes. Staying keeps your monthly payment low. But it's worth running the actual numbers before assuming a move is off the table, especially if the new home is smaller, cheaper, or in a lower cost of living area. Sometimes the math works out better than the gut feeling suggests. There are also options that let you access your home's value without giving up the low rate entirely, like a home equity loan or line of credit for renovations or other needs, rather than selling and refinancing everything at a new, higher rate. If you're trying to buy for the first time, understanding this effect explains a lot about why the market has felt so difficult. It's not just prices, it's that fewer existing homes are coming up for sale at all, because the people who own them have very little financial incentive to move. 3 things to know. If you own a home with a rate under 4%, run the real math before ruling out a move. It might be closer than you think. If you're buying, know that low inventory, not just high prices, is a structural part of why the search feels harder. And either way, mortgage rates are the hidden variable driving decisions that look, on the surface, like nothing to do with interest rates at all. A rate you locked in years ago can end up shaping a housing decision you make today, long after you've stopped thinking about it. We track the financial traps that don't make headlines, so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.